In 2026, global markets are not driven by a single trend, they are shaped by capital rotation. Instead of moving in one direction, money constantly shifts between sectors, asset classes, and regions. Understanding this process is critical. It explains why some assets rise while others stagnate, even when the broader market appears stable. Capital rotation refers to the movement of investment funds from one sector or asset class to another, based on changing economic conditions. Investors do not keep capital static, they continuously reallocate it in search of better risk-adjusted returns. This means market leadership is constantly changing. What performed well yesterday may underperform tomorrow. The current market cycle is driven by structural changes rather than short-term speculation. After the initial wave of interest in technology and AI, capital is increasingly moving into real economy sectors such as energy, infrastructure, and commodities. This shift reflects a broader transition from expectations to actual performance. Investors are focusing more on tangible value and less on narrative-driven growth. Several macro factors influence how capital moves across markets. Interest rates remain one of the strongest drivers. Higher rates push capital toward yield-generating and defensive assets, while lower rates encourage risk-taking. When inflation rises, investors often rotate into commodities or sectors that can preserve value. Global liquidity conditions further shape capital flows. When liquidity tightens, markets become more selective and capital concentrates in stronger assets. Capital rotation is most visible at the sector level. Technology may lead during periods of innovation and growth expectations. Energy and commodities often gain during inflationary or supply-driven cycles. Financial sectors tend to benefit from rising interest rates. This rotation does not happen instantly. It unfolds over time, creating opportunities for traders who can identify early shifts. Traders who understand rotation focus on relative strength rather than absolute performance. Instead of asking whether a market is going up, they ask where capital is flowing next. This approach helps identify emerging opportunities before they become obvious to the broader market. Capital rotation is deeply connected to macroeconomic context. Economic data, central bank policies, and geopolitical developments all influence how capital is allocated. Without macro awareness, market movements can appear random. With it, patterns begin to emerge. One of the biggest mistakes is chasing past performance. Many traders enter a market after it has already attracted significant capital, increasing the risk of entering late. Another mistake is ignoring broader context. Focusing on a single asset without understanding capital flows often leads to incomplete analysis. Capital rotation is the engine behind modern markets. In 2026, understanding where money is moving is more important than predicting individual price movements. The MNCTN global perspective focuses on identifying these shifts early and adapting strategies accordingly. Markets reward those who follow capital, not those who follow noise. In a dynamic environment, success comes from recognizing that markets do not stand still, and neither does capital.